Hello, friends. Welcome you back. It's been a while. It's been a while since I last uploaded a video. I appreciate those that try to interact with me on Telegram. Thank you so much. So I've been busy. Really, I be busy trying to trade for myself. So that's why I'm not able to upload certain videos. But today, let me quickly talk about something. Equal laws, basically equal laws. How do we deal with equal laws? By the way, this is an episode. This is SMC. SMC. There are guys that texted me recently, and they are into SMC. Trust me, you guys. It's okay to learn it. It's not a holy grail. You get, so don't never think that there is a holy grail strategy, because personally, I've also been a student of many, but they are all relevant. But my question to everyone, please, I like questioning people. Don't just watch a single video and you think everything is over. You get? Because as I always say, personally, my journey started in 2018. 2018. So if I come, I'm just trying to compress the things personally that I've come to learn. There have been many mistakes that I've made, and now I have a story. So all in all, you have a story. You build a story. Don't get excited with just a simple trick that I share here. You get, SMC is wide, but it's not holy grail. So I promised that I'm going to do 3 videos on SMC, then I'll do something in BTMM. I'm going to bring BTMM. You get, I'm going to be sharing some of the things that I've liked so much about BTMM, because I also studied it. So I'm not going to teach the whole strategy, but basically I'll be sharing something about moving averages. And why am I going to do that? It's because I realized that many of you, most of my viewers, like indicators. You get, so you like things that simplify life for you. It is okay. So BTMM, it is so good. You get, actually it was my first game changer. I learned the market maker behavior through BTMM. You get? So I learned that in BTMM. So what I want to really share is that if at all you came on the charts, you get, there is what we expect. There is what we call expectation versus reality. You get? And now let's suppose we're in a selling market. This is what we expect. You get? That's what we expect. And for a buying market, this is what we expect. You get, for the market to be making impulse runs up. You get, impulse runs up. You get, so in essence, we believe that the market maker sells to buy. You get, so they want to buy, so they will have to come and let's say they come and sell up to this point, and then they sell up to that point to make an impulse run up. You get? So what does it mean? It means there could be demand zones here or order blocks here that the market maker comes back to pick up the orders. So which means if at all um, the market maker wants to sell uh, let's say 300 million lots, because for us we are placing 0.01 lots, those have no impact. You get, those have no impact on the market. They just provide liquidity to the market. But people are placing orders of, let's say, 300 million lots. You get, because there is a daily trading volume of about 4.5 trillion US dollars in the market. So that's a lot of money. So let's say a hedge fund is placing these million lots. You get here, they may not b- uh they may not, let's say, they may not activate them at once. You get, they may first activate, let's say, 200 million lots to get this impulse move that has gone up, then which means they have a balance of 100 million lots. So the market returns back to this zone here. You get, to this zone here to pick them up, and then we get an impulse move that moves up, something like that. You get, though not always that the market will come back to those demand zones. So not all demand zones that are created have pending orders there. No, you get. So for those ones to differentiate, that's why you guys feel free to join my mentorship program. By the, I forgot to caution you guys, take this remaining time of December to learn. You get, take it to learn, because markets now are tricky. Markets are tricky. You get, they are very tricky. So that by January you are kawa, and then you're moving on very well. You get, so take time to learn now, because it's a festive season. Market makers are also maximizing profits. So this is not a very, but for as long as you have a good setup, please, you can trade. You get, and for synthetic indices, you can trade, but you take time to learn, so that come next year you're good to go. You get, you're good to go. So now, then let me go back to business. Then for a selling market, that's it. We believe the market comes back to an area of supply, you get, or to some order block there, and then there is a difference between order block and those supply corners. You get, later on I discovered it through learning. There is a difference. We can have a supply area within an order block. You get, I'll not I'll not differentiate it here on the channel. That one, I'll be doing a disservice to my students. So now we break a structure. So for a good for a good supply area, there must be a break of, there should be, not a must, there should be a break of structure. So as we break a structure below here, so what do we expect? We could be having numerous supply areas here. You get, don't get confused. I want to drive a point to something. Now we have this extreme point here. Now sometimes the market may just return back up here. You get, it may pass these areas here. So that's why I like, personally, that's why I like doing analysis, let's say on H1, H4, the daily, because if I mark up those areas, let's say on H1, you get, I've marked out those areas, and then let's say this is extreme supply. You get, extreme supply, because we found supply here, we sold, we broke structure, and now even here. So we have something like this. Now there are those moments, that the market comes, it passes here, and then it comes here to create what we call equal highs, or the market may create equal lows, whereby this was the supply, this was the demand, and now the market may not react to that area there, and then it comes and react to something like here. It may not even be equal. You get, it may not be equal, but then we come there. You get, and then we buy. You get, so it creates equal lows. You get, now in SMC we believe that anything that is visible to everyone, anything that is visible to everyone is what we call liquidity. You get, is liquidity, because the market maker, people are seeing this as an area of resistance. You get, let me change the color here. People are seeing that area as an area of resistance, and this one as an area of support. So what does it mean? There are a lot of orders that are resting here. You get, there are a lot of orders that are resting here. Remember, now you have more power, and you have more, because you have more money, you can place 1,000,000 lots. Now, but you, to move the market, you have to make money. You have to be targeting those areas where the money is. So what does it mean? The market comes in those zones to make, the market maker moves to those zones, because they even create them so that they can make money from there. And now this is how they make money. And this is what you should be watching out for. That's why it's good to do a top-down analysis. The market maker may choose to move up. You get, sometimes during news, they make a quick run up, and then they come back into the zone. You get, now let's suppose people were looking at this area here, up here, as an area of resistance. So the moment they break out, assume this is H1. You get, this is a significant push outside. So as they push outside like this, people who were early sellers, there are people who are early selling here because they think this is strong resistance. Now they come and sell here, but then they move up, most of the time about 30 pips. Most of the people have their 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 stop loss in the range of let's say 10 to 30 pips. You get, so now they will move. This is what we call a liquidity sweep. Then they come back in the range within no time. You get, within no time they come back in the range. And even we have then we some people here, the market will be, they will come and they buy here, but all of a sudden the market comes just there and then it does exactly what they expected it to do, but when they've lost. Now early sellers are taken out, and even people, breakout traders or breakout artists, also are get taken out here. The market breaks below here, they quickly go and start selling, you get, and then the market reverses on them. So the market maker has made money. Trust me, even if you're the one, that's what you would do. You get, that's what you would do. So now that's why I bring in the concept. Today we are going to, given that I've illustrated, we are going to take a case example of equal laws. You get, we are going to take a case example of equal laws. Equal laws. Now, other concepts, points of interest. Now, this one here, this buying trade of today, this is VIX 50S. This buying trade of today, it's because we were in the 1 hour point of interest or a higher time frame point of interest. So now I'm not going into that. I just wanted to share about equal laws. Now, this is what we see. The market came there. You get? Let me change to blue. Blue, I think, is more visible. Let me change to that. You get? So we have these equal laws here. And now the funny thing about it, in the previous video, I talked about liquidity points. Sometimes when you mark out, sometimes it's good to get a trading range. Personally, I like getting a trading range. Now let's look at this. Let's look at this. You see, marking out the high of the previous day and the low of the previous day. You get the high of the previous day and the low of the previous day. Yesterday, this was the low. You get, but then the low of yesterday was equal to the low of the other day. You get? So basically, we got two laws here that were equal. You get? Now, for me, when I mark out the high and the low of the day, I know the market would either be targeting the low of the day or the high of the day. You get? But then we have these equal laws here. What did the market do? It first came for these ones here, for these laws. People were looking at this as resistance. They came below them, they took them out, you get? And then what did we see? We got a demand failure. Now, demand failure, all that, for those that were looking to polish up SMC, maybe I'll talk about that later, demand failure, and then maybe change of character. Now, we took them out, you get? And now the market was expanding to the upsides. At least, personally, I like targeting the latest swing point because I expect a reaction, the market coming back into the zone. And then it's possible because it's possible that the market will, because I expect a reaction here, at least a sell reaction, and now we just moved out a little bit, and now the market, it's possible that it can target down, because what are most people seeing now? What are most people seeing now? People start drawing trend lines. I'm not saying that trend lines do not work, but at least in SMC, we believe anything, these trend lines, we call them liquidity anyways. So it's not my fault. Though those ones that are trading patterns, don't give up on those strategies. Nothing is holy grail, even SMC. My boys yesterday were killed in the news. You get, like they lost money in SMC. And then those that were using BTMM were winning. You get? So don't get scared if you're trading patterns. But at least this, in essence, this is liquidity. So many people are seeing this as resistance. So, anyways, so I expect a reaction downwards. So this is how you'd have gotten the trade for today. So we come and start marking out areas. Now this is M15. We start marking out those areas where we expect reactions. If at all the market continues to sell, then we can say, so which means if you're selling here, these are my targets, all these fair value gaps, in this fair value gap here. You get? But then this imbalance I'm targeting, this was the demand zone anyways that I'm targeting. So if you're selling here, you can sell up to this point, and if they continue the market down, well and good, you continue to hold. You get? So, and then we start targeting areas up. But now I believe we are really going up. So all I wanted you, what is the main point you get out of all this? If I can summarize, now when you see something like this, these equal laws, you get, you wait for the market to see whether it may choose to go up. If it chooses to go up, well and good. If it chooses to go up, you get, and sometimes we may get something like that. That is fine. And then if it chooses to first go for the lows here, and then it starts to make a shift in structure, then after making a shift in structure, it will create a demand zone. As it returns, you buy. You get? So don't take this. If I told you in SMC, those I got those that wanted to polish up today, and I wanted to look at the equal lows, but then I've illustrated even for the equal highs. You get? And then we start looking out for liquidity points, those areas that are visible to everyone, these trend line traders here. You get? So this was the target. This area, these people were the target of today. You get? Were the target of today. So for now, I wish you the best. I thank you guys so much for watching, and please subscribe. I hope to bring on more content. Please also like the videos. You get, like the videos. That's why, by the way, you guys, do you know why I don't upload so often? It's because people watch, people don't like, and then if at all you've not liked it, please, you also comment, and then you tell me where to improve, so that you can also like the content, because you come here to learn. So I would expect at least a like or a comment. You get? Or a comment to help me improve. You get? To help me improve on the content. Otherwise, I also keep there also focusing on my charts, because I told you my main business is to trade for myself. You get? So I don't want you guys to think that I'm only interested in mentorships. Mentorships are optional for those that want guidance and asking questions and all that, and the detailed one-on-one things of that sort. So mentorships are optional much as they are good. And there I'm teaching SMC, though I added on the part of moving averages of BTMM, but it's optional. You get? I only explain moving averages a little bit, but generally we look at SMC. You get? SMC or ICT. Anyways, there I failed to differentiate so much between the two. So for now, I wish you the best.